Hi guys, my name is Rajiv Rebello. I'm the principal and chief actuary of Cova Insurance Services, and I'm here to talk to you guys about our webinar, which is why fee-only fiduciary financial advisors should really be considering no commission fixed and indexed annuities for their conservative high net worth clients over traditional bond investing. Essentially, what we're going to be talking about is how traditional bond investing really hurts high income or high net worth clients simply because of the ordinary income taxes and a lack of tax deferral, in addition to the volatility associated with the changes in interest rate movements and capital gain losses. And it's because of these reasons that clients are really considering fixed and indexed annuities simply because of the protection and the potential upside that they provide. So especially conservative clients are looking for some sort of protection against volatility and market corrections, and indexed and fixed annuities provide that for them. Unfortunately for fee-only and fiduciary advisors, a lot of these fixed and indexed annuities are high commission products, which means the fiduciary financial advisor can't incorporate them into their practice. However, because of fee compression and the way the industry has gone in terms of wanting to meet consumer demand for better products and less fees, there are now no commission fixed and indexed annuities on the market. And essentially, we're talking about how the reduced volatility in these products are better than they were in the past, and also better than typical bond investing, and how the long-term returns for these no commission products after tax returns can be better for high income conservative net worth clients over traditional bond investing. So let's go ahead and get into the presentation. Again, the secondary subtopic is obviously why volatility and taxes hurt long-term returns, and how fee-only financial advisors can really capture additional AUM and additional clients and offer additional services to their clients through incorporating no commission and indexed annuities. So now let's go ahead and just talk about the general problem for clients and advisors when it comes to questions about market volatility and corrections. So in terms of conservative clients, bonds are always a typical go-to option, right? So you're just changing your allocation from equities to bonds for those conservative clients. However, that does come with an opportunity cost, and that opportunity cost is essentially that bonds have low yields and high tax rates for these clients who are investing in these bonds, getting dividends or coupon payments, and paying high ordinary income tax costs on that. On top of the fact that bonds typically are lower earning than their stock counterparts over the long term, right? Also, the issue is that volatility around capital gains and interest rate movements really reduces long-term returns, as we'll be seeing in the next few slides. So to summarize, high net worth conservative clients really need options that both defer taxes and reduce volatility in order to increase long-term after-tax returns. So, before we get forward, let me just go and talk briefly about my experience here. I'm an actuary by training. I actually help to price and design life insurance policies for New York Life, looking at mortality and lapse assumptions as well, and essentially trying to make products profitable for the life insurance company. In the process, I saw exactly how high the expenses on some of these products are in the early years, and how many people cancel it and walk away with very little because of these expenses. I then moved on to work on the life settlement side, managing a portfolio of about 6,000 policies with about 18 billion in death benefit, basically helping to make the policies profitable for the policy owner by structuring the product to make sure the premiums are less. And from there, I just started my own consulting practice, essentially geared at helping institutional and high net worth clients and RIAs basically how to better structure life insurance products to minimize premiums and maximize the returns for their clients. So it's that experience that I'll be kind of using to dive into our topics here. So just for a quick table of contents, we're going to start with the state of the economy, right? Again, how volatility and taxes hurt long-term returns, why clients are going towards fixed and indexed annuities, and sales of these products are growing because clients are worried, right, about corrections. They want some sort of protection with some principal upside, and annuity products are meeting that demand. Let's talk about, again, like I said, the growth of fixed and indexed annuities because of this demand for both principal protection and potential upside. And how fee-only advisors are losing out because clients are getting these products from their non-fiduciary advisors because of the commissions involved. And then we'll be talking about the growth of, or the implementation of no commission type products, and how that could be a fit for fiduciary fee-only advisors. We'll then be talking about like the structure of the annuity and how all an annuity is essentially investing in corporate bonds, but with a more of a buy and hold strategy as opposed to investing in those corporate bonds rather, outside of the annuity and getting taxed at high tax rates and a lack of tax deferral. We'll be talking about the growth of the no commission based model and how that benefits fee only advisors and how they can incorporate these products into their existing systems, right? And either get a percentage of AUM fee on the assets in these products or just charge a financial planning fee. We'll then do the comparison, right, of no commission fixed annuities versus just investing in corporate bonds outside of the annuity. And finally, we'll just talk about the, who we are, what COLVA does, and the CFP credit that's available through this course. So let's just kind of dive into a quick overview of the market. All of you financial advisors are well aware of this, so I won't spend too much time on it. But obviously, stocks are, have increasing returns, much higher returns than bonds in the last 10 years, from 2008 to 2017 has kind of shown that. But also the stock market's a lot more volatile than bonds, right? So if we look at kind of 10-year returns, the Bloomberg Barclay Bond Fund is lower returns, but also lower volatility than the higher earning returns of the S&P 500. So conservative clients worry that this, historic bull run we've been on will lead to some sort of correction in the future. But the problem is in terms of shifting their allocation, right? Bonds and treasury markets are unappealing simply because of the reasons we've talked about in terms of lower yield and higher taxes, right? So for conservative, high net worth clients, that's an issue. So now I really want to spend some time talking about the importance of understanding volatility, right, and how it hurts long-term returns. And even though I give you an expected annual return, that doesn't mean that's the expected long-term return. So what we're going to do is we're going to imagine we invest $1 million into a couple different funds, right? All of them have an expected annual rate of return of 12%, but different ones have different volatility. So we'll see one with 0% volatility. So that means it's not, the 12% isn't going to change from year to year. The other one can go up or down by 5%. The other one up or down by 10%. The other one up or down by 30%. But in all cases, the average annual return is 12%. So if we just look at the case here, it's 12% in the first year, 12% in the second year. So at the end of year one, you have this value, and at the end of year two, your value. Then your 2-year IRR on a compounding basis is 12%. However, now let's look at another case where you go 17% up in the first year. The next year is only 7%. So the average is 24%. But if you actually look at do an IRR calc, so not just a straight average, but say how much are they actually earning, it's an 11.89% IRR. And again, the volatility is creating that. It's a mathematical type solution. So same thing, as you increase the volatility, or 22 and 2 is still your 12% and mean return, but on a compounding basis, that's 11.55. So as the volatility of a fund increases, even though they're giving you an expected annual return, that doesn't mean that's the long-term return here, right? So in this case, your average is still 12%, but the long-term return is only about 10.2%. So here's a quick little tidbit. If you look at the S&P 500 annual returns from 1926 to 2018, and just do a straight average, just average all those returns, it's about 12%. But if you do this compounding analysis, you'll find that it's only about 10%. So investing in the S&P through this, you're losing, that 2% on volatility. So even though a fund might say it has an expected annual return of 12%, you really need to do some analysis and think, well, what's the long-term return for my clients if they're investing in the long term? So again, shifting allocation from equities to bonds allows for less volatility and also a relative protection of long-term returns from volatility drag. So as we talked about, equity funds have higher volatility, and that's why the investing in bonds, while it does come at lower yields, has less volatility, and so relative to the volatility loss you'll be facing in equities, it's less, right? So that's again another reason why advisors kind of do this shift, right, to bonds for more conservative clients. However, again, there's an opportunity cost with everything, and increasing an allocation to bonds, while it means lower volatility, it also results in lower yields and a greater percent loss to taxes. So here's just a quick example of the difference between long-term capital gains and ordinary income tax. You have an 8% expected return with the S&P versus, investing in a bonds fund making 4%, but getting taxed at a much higher rate, right? Because the long-term capital gains is smaller. So you're paying a larger percent of your overall return to taxes, and that's on top of the fact that the pre-tax return is already half of that of the equity market, right? So it comes at an opportunity cost, and that's why investing in bonds, is not exactly, the most efficient way for conservative clients. On top of that, it's important to acknowledge that we're in a low interest rate environment. So if you're holding for the long term and interest rates start to rise, these long-term bond funds will experience losses. So, and here's just an example, in 2018 of when interest rates kind of rose on different duration funds, right? So the long-term duration funds took the largest hit, as it makes sense, right? So it's kind of a tough thing for clients, for conservative clients who are like worried about losing money, and you shift their portfolio to more bonds, and then as interest rates rise, you have those same conservative clients. Well, why are we losing money? I told you I wanted to be conservative. So it's a little bit tough. I mean, obviously we understand, long-term returns as interest rates rise, you're investing in higher interest rate bonds, but the short term, you're still going to have to explain those losses, right? So now let's go ahead and talk about, well, what are some alternatives to bond investing for clients that want the principal protection and lower volatility that bonds provide, but without the detriments of being tax inefficient and subject to capital gains losses, or short-term capital gains losses rather. And that alternative that we'll be talking about today are annuities. So I just want to quickly go over how annuities work, just so you get an idea of what they are before we go deeper into the conversation. So we're going to cover 3 types of annuities today. We're going to cover fixed annuities, indexed annuities, and variable annuities. So let's just start at the high level with the fixed annuity, right? Well, with a fixed annuity, the client deposits a single premium and they get a fixed rate of return, right? Subject to the portfolio rate. So in this case example, we're looking at a 3.6% that every year the client can expect to make. And when we look at the cost, there's no explicit cost, but obviously there's an implicit cost between what they're making, whether it's the 3.6%, let's say, and what they could be making elsewhere, right? In the annuity versus outside the annuity. So obviously, if you're investing in bonds that are making 4%, and this is a pretty good alternative, but obviously if you're looking at equities that are making a much higher rate at 8% or 10%, then it's not an equivalent comparison. So there's an implicit cost there. So that's why it's important to consider, well, what are you using to invest in this fixed annuity, right? Again, another cost is that the gains are taxed at ordinary income rates. When we talk about the underlying assets, again, we'll mention the life insurance general account portfolio mainly consists of long-term investment grade corporate bonds and treasuries. It's a buy and hold type approach. So the ideal client, they want some sort of fixed return and want to really limit in their market and interest rate risk that they're taking, as well as benefiting from the tax-deferred gains that these products offer. The next product we'll be talking about is the indexed annuity. And the indexed annuity, similarly, you do deposit a single premium into the product, but your return isn't fixed every year. It's dependent on the performance of an index subject to a floor, which is usually 0%, and a cap. And in this case, the example kind of what we'll be talking about is a price return index. Again, we'll talk about the difference between price return and total return later, but the floor is 0% and the cap is 7.4%. So if the market goes negative 15%, you're not losing any money, you're getting 0%. But equivalently, if it goes above 7.4%, you're capped there. And obviously, it's the same. The implicit cost is both between the capped returns and what you could be getting on an uncapped investment, over the long term. But in terms of the underlying assets, those underlying assets are the same long-term investment grade corporate bonds and treasuries. And you might be saying, well, how are they able to get a higher return on these caps and the floors? They're just buying options mostly. So they're investing in these corporate bond vehicles as well as purchasing options, right? So the ideal client here, analogously, they want the principal protection and reduce volatility, but they want to capture some of the upside, right? Not all of it, but they want the protection that comes with the 0%, but they want some of the upside of 7.4%. Whereas a variable annuity is different in that there's no protection and there's no floor, there's no cap. You're just investing in the equities directly, and the gains are taxed at ordinary income rate. In this case, the underlying assets, you're investing in a fund, it's equities directly. We'll talk about the downsides with being investing in equities and being taxed at ordinary income rates later. This ideal client just wants to kind of looking to maximize returns and are not thinking too much about the taxes, but they do want that tax deferred growth while, still taking full market risk. So now let's talk about, well, how do no commission products, a no commission annuity, make a better fit for clients and their commissioned counterparts? So no commission annuities typically offer higher caps than their commission-based counterparts. Again, simply because they're able to minimize the expenses on some level, so they can offer better benefits. Right? When you minimize expenses, you can offer better benefits. A no commission annuity offers a lower than corporate credit risk with higher than current Treasury pre-tax yields. So what does that really mean? Well, you can invest in the same corporate bonds that the annuities, life insurance carrier rather, reserves are investing in. You can do that outside the annuity, but there's, as we'll talk about later, there's more corporate protection, or not corporate protection, but protection with regards to the reserves in this account because they're regulated, right? So the government is ensuring that they have enough in their reserves to meet their obligation. So you're more protected than investing in corporate bonds outside of the annuity. And the returns are obviously, because the account is a mix of both corporate bonds and long-term Treasury yields. You're going to see the pre-tax yield be between the corporate bond yield and the Treasury yield. On top of that, no commission annuities offer tax-deferred growth for investors. So while you can invest in the corporate bonds outside of the annuity, you're going to get hit with that taxes on the coupon rates or the dividends each year. No commission annuities offer reduced volatility for investors, so you're benefiting from buying into investing into a buy and hold portfolio, as opposed to kind of a shorter duration fund that is constantly rebalancing, right? And then subject to the capital gains losses or appreciation rather, also as well on the rebalancing. So no commission annuities offer investors the ability to have the principal protection that's guaranteed by both the life insurance company from the reserves, as well as earn a higher potential after-tax return than if they were to invest in the bonds outside the annuity. And this higher long-term after-tax return is due to the tax-deferred growth and reduced volatility. So even though you could invest at the corporate bonds and have a higher pre-tax yield, as we'll see, even though the pre-tax yield of the fixed annuity might be less, the long-term performance actually benefits due to the tax-deferred benefits and the reduced volatility, as we'll talk about in a second. Well, now let's talk about, what are the drawbacks of an annuity, right? So the annuities are taxed at ordinary income rates, while equities are taxed at long-term capital gains rates. So if you're thinking about investing in equities, right, you don't necessarily want to do so within an annuity because they're going to be taxed at ordinary income rates. So you're better off investing your equities directly in the market, right, and getting the benefit of tax long-term capital gains treatments. The second thing are indexed annuities are typically indexed to the price return, not the total return. So if you look at the stock market and it does 10%, let's say 8% are from the capital gains appreciation, that's a price return, but 2% is probably coming from the benefits of dividends that some of those stock companies are kicking off to investors. So with an index annuity, you're only getting the price return. So that's a drawback. Again, any annuity gains that are withdrawn before age 59 and a half are typically hit with a 10% penalty, right? So it's again a retirement type vehicle. So that's why you're getting the benefit of tax deferral, kind of like your, a 401k or traditional RIA. The other thing is the current fixed crediting rates and caps are subject to change. Again, if market conditions change, the life insurance company will adjust the rates accordingly, but not to the extent that you'd see absorb interest rate risk or market risk in the direct market, investing directly into bonds, simply because again, the life insurance general account portfolio as a buy and hold is typically not as sensitive to changes, although it will change as the market does as well. So let's just talk quickly about the benefits of tax deferral. What we've done here is shown a 12% fund, an 8% fund, and a 4% fund. Obviously, the benefits are highest the more the fund is earning, the greater benefit it is of getting the tax deferred benefit. So after 30 years of a 12% fund, you're looking at 250% or 260% additional gain, as opposed to if that was just taxed every year, right? You're putting the gains back into the fund, and you're benefiting from the tax deferral. So on a 4% fund, it's only about 17% or so here. But again, keep in mind that tax deferral also benefits those who are getting taxed at a higher rate. So just as the higher the fund earns, it results in better tax deferral. The higher the tax rate of your client, the higher the tax benefits for deferral will be for them as well. I just want to do a quick example that kind of shows, how investing in fixed annuities or index annuities can offer lower volatility. So we're going to use an index, the S&P 500 price return index for the last few years. You can kind of see it in this column here. In 2013 did very well, but we as we saw in the initial chart, it jumps up and down, right? Whereas if you just get a fixed annuity, it's fixed, right? So it might go up a slight amount, maybe 3.5 or 3.6, but again, it's generally constant. The volatility is less, while the yield is also significantly less, though, right? As we saw earlier, investing directly in the market, while you have to absorb the ups and downs, the long-term yield is better. But if you're worried about loss, right, losses, this fixed protection is a benefit, right, for clients looking for that. Analogously, with an indexed yield, you're not getting the full upside of the market, but you're getting part of it, right? But you are also protected on the downside. So, but still, this is a lot reduced volatility in comparison with investing directly in equities. So shifting allocation from equities to bonds does allow for lower volatility and more principal protection. But it comes at the cost of lower pre-tax returns and a larger percentage loss to taxes. So doing something like investing in annuities instead offers a better fit for those types of clients. So now let's just talk about the composition. Well, if I put my money in an annuity, what am I actually investing in? Well, the life insurance company that's taking your premium is investing it in their general account. They're setting up a reserve. We'll talk about that later. Well, that reserve consists of long-term investment grade bonds. So 48% are about long-term corporate bonds, and another 11% are government bonds, and then you have mortgages, right? And then, or mortgage bonds rather, and then you have just straight mortgages, investments, and other investments here. So most of the investments are in long-term bonds. You could get these same bonds outside the annuity, but like we talked about, in this case, it's a buy and hold type approach, whereas bond funds typically rebalance and are subject to losses as the interest rates move, right? So, well, what are additional benefits that life insurance reserves have in terms of investing in bonds versus just investing in corporate bonds outside of an annuity, right? So let's kind of just look about that. Oops, back a second. Let's go back a couple slides. So now let's just talk about, well, what are the downfalls of corporate bond investing directly, right, versus doing so within an annuity or within a life insurance reserve. So with general corporate bond investing, the company isn't setting aside assets at the beginning to match your bonds or to match their obligations, right? They're borrowing money based on the general financial strength of the company, but they're not setting aside specific assets to do so. Whereas when you invest in an annuity, the life insurance company is explicitly setting up a reserve to meet their future obligations, so it's protected on that level. On top of that, there's government regulation over the life insurance reserve. So the government wants to make sure that the life insurance company, if they're promising something, right, a guaranteed return, that they have enough reserves to meet that obligation. Whereas general corporate type bonds, they don't have such regulation over the company to ensure that they're able to pay you back. Again, the protection, life insurance reserves are protected from creditors. So if the company goes bankrupt, those reserves are protected. And again, there's a reason why life insurance companies don't go bankrupt, is because they're well regulated, whereas corporate companies can, right? No government guarantees. Typically, the government will guarantee the reserve account up to $300,000 on any one policy. And again, that's just a way of the government saying, look, if you're going to make a promise, we want to ensure, since we're regulating, that you are in fact providing that. Whereas there's no government guarantees when you invest in corporate bonds. So now let's just look at pre-tax yield. We alluded to earlier how pre-tax yield is not the same thing as long-term after-tax yield. So let's just quickly go over that. As of June 2019, the high-quality corporate bond par yield is about 4.11. The no-commission fixed annuity is about 3.55, and the treasury yield is about 2.59. So it's in between, right? The no-commission fixed annuity. But as we'll see, in our Monte Carlo analysis, this is the pre-tax yield. The reduced volatility actually will make for a greater after-tax yield, long-term after-tax yield than the high-quality corporate bonds direct investment. So now let's talk about why have fixed and index annuity sales have been growing so much, right, since over the last few years? Because investors, as the market does increasingly well, there's a fear of correction, right? It's a historic bull run. There's a fear of correction and volatility, and conservative clients who are more emotional rather than rational, understanding the long-term investment, they're flocking to this. So we can see that in 2018, right, fixed annuity sales were in the billions, about $130 billion, with indexed annuities about a little under half of that, at about $50 billion. So investors worried about market corrections and low yields are increasingly turning to fixed and indexed annuities, right? Indexed annuities, again, clients who wants part of the upside is expected to grow to almost $100 billion by 2023. As these investors want both safety and a part of the upside. The unfortunate part for advisors or fiduciary fee-only advisors is that most of these products are high commission type products, right? So if you're a fiduciary financial advisor, you can't offer this through your services. And on top of it, you wouldn't necessarily want to, because a lot of these high commission products, and not all of them, some high commission actually perform well. A lot of them come with high expenses that are not necessarily in the best interest of the client. So as a fiduciary advisor, you couldn't even recommend it if it was in the best interest, because it's not. So the problem is that the way these products get marketed to consumers, remember, they are meeting demand. So the clients, the investors, they want protection. They want the safety that these products provide, but they're only offered by annuity agents who are making a high commission. And that was the distribution channel. For so many years, that's been the distribution channel. So these annuity agents, they market it, they get the clients, the client pays the annuity into the life insurance company, and the life insurance company pays the annuity agent a high commission. And then they deposit the premium into an annuity product, but that annuity product has a high expense because they got to pay the annuity agent somehow, and that comes from implementing an expense here. So the use of high commission-based product relies on high commission agents that result in higher expense products. So not necessarily the best product for the client, but these guys are selling it, and the client, they want the protection, and they don't have a fiduciary advisor to say, hey, you know what, this is not necessarily in your best interest, but they are meeting the emotional need of the client. The issue with this, obviously we talked about just the conflict of interest here. The issue with the industry, though, is that advisors are going away from the commission-based model, right? They're going away from, offering some financial services, but really just selling commission-based products, because they realize, look, if I do that, then I have to find new clients every year. It's better just to build up a base and charge my % asset under management fee. So if we look at the assets managed by advisors that don't take commissions, it's gone from in 2001 to 0.8 trillion to in 2017 about $4 trillion worth of assets. So it's multiplied by 5 times, right? Because advisors realize it doesn't make sense. Let me just be a fiduciary advisor. I'll just charge an asset under management fee. I'll build up a large asset under management, and I don't have to find new clients every year. So advisors are going away from this, which means they're no longer interested in selling the commission-based products. Well, so what does the life insurance company do? They develop no commission-based products that are meant for fee-only fiduciary RIAs and just fiduciaries in general. And the way they work is that it relies on the RIA fiduciary to understand how these no commission annuities work and fit into the client's financial plan. They educate the client on that. The client invests in the life insurance company with the premium, and the premium is deposited into a better performing no commission product, simply because the life insurance company doesn't have to put in high expenses here to account for the high commissioned agent, because there is none. There is no high commission agent, but they're relying on the fiduciary RIA to do all the education here. So no commission annuities offer better products in terms of higher caps, lower expenses, etc. to fee-only RIAs that they can implement into their fee-only system. So they're either charging a fee, or if they put $200,000 into the product, they're getting a fee on that $200,000 each year and the gains, right? So that 200,000 fixed annuity does 4%. Again, they're getting that 1% gain or whatever their fee is on that. Well, if you think about this, well, that's a lot of work, right? For the RIA fee, they have to understand annuities, they understand how they work. Then there's the systems element of it. Well, making sure that the life insurance company's assets are reported into their system, and then the RIA can then just charge their fee, their AUM fee. So it's work on the RIA's fiduciary's standpoint. So in order to counter that, the life insurance company said, you know what? Instead of doing advertising on TV or other specials, they're going to pay a marketing fee to the BGA, a back office support that it's going to help the RIA. The RIA is completely involved in dealing with the client. The BGA just helps educate them, kind of like what I'm doing now today. And what they do is they educate and they help implement them into their systems to make it seamless. So all the RIA has to worry about is kind of understanding clients' emotional background and their financial needs, and finding the product that best fits it. In exchange, again, the client is getting a better performing, no commission product, right? Because the fiduciary is acting, helping them act in their best interest. So this back office, again, helps remove the complexity of it and ease the process implementation. Now, I just want to quickly go into well, how do these perform in the long term, right? We need some assumptions to make here, and I'm going to use those assumptions for the last 10 years of the bond fund is about 4%, right? We saw the standard deviation was about 3.34% here. Obviously, the tax right is ordinary income. Stocks, we're using just the price return component of 8%. Again, here's the volatility. Again, they're taxed at the lower capital gains. Then we're going to compare that to the fixed annuity and then the indexed annuity. We can see the after-tax annual return. So I want you guys to pay attention to this because it'll be key in understanding how volatility hurts the returns here. Again, while equities are more volatile than bonds, bond funds are subject to higher volatility than life insurance reserves because they're subject to capital appreciation loss, whereas the general account portfolio of life insurance companies are buy and hold. That's why this volatility here is lower. The volatility assumption here is lower. So now let's kind of look at our results and kind of, before we get into the graph form, let's look at the results here. You can see that the bond fund, again, the standard deviation, we got the tax rates. On an expected annual tax rate, on an annual basis, if we just take 52% and subtract that from the 4%, we're left at 1.92%. We see the fixed annuities at 1.72%. And again, this is on an annual basis, so the mean annual, not the long term. However, we look at the simulated 30-year compound return, we can see that it's 1.80%. So you're like, why is the difference? Why is it not 1.92? So it's losing that 12 basis points because of the volatility. So when we look at the stock market, on the other hand, you can see that it actually performs it performs better because remember, stocks, you're getting a long-term capital gain, so you're doing better than the 5% because you're not paying taxes every year as you are with the bond. So like you're benefiting from the tax deferral, as opposed to, again, if you were to pay taxes every year, that's what it would look like, right? So you're actually doing better investing in equities with the long-term return. The fixed annuity, you can see again, there's a gain here of 2.39% versus the annual, and you're gaining that because you're not paying taxes, and also you're reducing the volatility, right? So those two components. Analogously, with the indexed annuity, obviously it outperforms the fixed annuity because you're getting part of the upside. But again, the long-term 30-year compound return is higher than the expected annual return because of the reduced volatility and the tax deferral. And we can kind of see that, again, it's easier to see that in graphical format. Whereas, again, you can see that the bond yield is about 1.92, and slowly over 30 years, it decreases to 1.80% because of the loss due to the volatility. Whereas the opposite is true for the fixed annuity and the indexed annuity. The fixed annuity actually increases over time, right? Because of as you go on, it's getting more and more benefits of reduced volatility and tax deferral here. So while the after-tax compound annual bond fund returns decrease over time due to volatility drag, after-tax returns for fixed and indexed annuities increase due to reduced volatility and tax deferral savings that are then simultaneously reinvested into the fund. However, if we look at the variable annuity, we don't see the same story here. And let's just kind of quickly talk about why. Again, if you invest in equities directly, right? You're getting the benefit of long-term capital gains that are already tax deferred. You're not paying gains until you realize it, right? Um, the opposite side is that, if you invest in those same equities within an annuity, you're now taxed at ordinary income rates. So your earnings are always going to be lower, right? Um, because of that loss. So that's why when you think about it, all clients who have a variable annuity, it's not necessarily, even though there are great no commission variable annuities on the market, it's not the best thing to take it from one high expense annuity VA product and then put it in a no commission VA product, simply because you're still taxed. You're investing in equities and getting taxed at ordinary income rates. You'd actually be better off taking that VA product, doing a 1035 into a no commission fixed and indexed annuity product, and then looking at the portfolio you're managing for the client outside the annuity and adjusting the allocation percentages accordingly. So let's just do a quick example. So let's say your client is invested in 40% bonds and 60% equities, outside the annuity, and they also have $300,000 in a VA product, high expense VA product. Well, you take that $300,000 VA product, you'd invest it into a no commission fixed or indexed annuity, again, and that essentially serves as your bond alternative. So now that you have $300,000 of additional bond investment, what you do is you look at your portfolio that's 40% bond, 60% stock, and you say, you know what? Instead of 60% stock, I'm going to make it 70% stocks, because I have this $300,000 bond alternative that is essentially operating better than the bond, but with a similar risk. So that's the way of thinking about these VA products. If you're a financial advisor kind of dealing with it, it's not just to do a simple 1035 into another VA. It's to fundamentally, get into something that's a better tax efficient strategy for your client. So now let's get at the crux of the message here, and that is that even with or without fiduciary fee only advisors, the fixed and index annuity market is going to grow. It's going to grow because they are meeting a demand, which is meeting the client's desire for principal protection in a market where they're concerned about losses, right? So the difference is either the high commission annuity agent is going to offer it to the client, or the fiduciary fee only advisors are going to say, you know what? It's actually better for me and for my clients for me to provide these no commission products than to let my clients go and purchase it from a high commission agent, right? But obviously it relies on fiduciary advisors, taking more initiative and incorporating this into their business. Otherwise, it's losing this business that they could be, again, investing assets in and getting a fee, and watch the high commission agents take it from them. So now let's just quickly talk about, what it is that COLVA does here for our clients. A lot of it is a life insurance policy review. So are your clients paying too much in premiums for life insurance? And if you think about it, they bought a policy and they're paying, let's say $30,000 a year to keep it in force to age 100. They're maybe 70, however, let's say their life expectancy is only 82. Well, why are they paying to live to age 100? So what we do is kind of look at it and say, actuarially, like, how much should they be paying? Are they better off taking that $30,000 premium, making it only $10,000, and then having the advisor invest that $20,000 differently in a different strategy, right? So instead of wasting it into a life insurance product where the advisor is not getting compensated on, right? That's additional $20,000 a year the advisor can be using. And then it's better for the client because they're not expected to live to age 100 again. And then having us look at it, are there better investments? Are there better life insurance policies out there? Also for estate planning issues, as clients are looking for the tax, remember, the death benefit flows tax-free to the beneficiaries. How do you best structure that to facilitate wealth growth to the next generation? So essentially, it's looking at how do I maximize the death benefit IRR and minimize the premiums paid for your client. That's what we help out with, and helping to implement insurance solutions for them. On the life settlement side, essentially, some of these policies the client no longer needs. So instead of canceling it and getting nothing back for it, can they sell it as an asset on the life settlement market to life settlement investors? And how can COLVA help them do that without paying the 15% to 30% commission, which is typical of life settlement brokers? So if you have a client who has a policy they no longer need, give us a call, and these are things we can kind of help you with. And the last thing is investing in alternative investments. We help manage life settlement funds. So if your client is worried about volatility in the market and low bond yields and are wanting something alternative that is not related to market, not correlated to market and interest rate risk, we do help. We run investments with regards to investing in life settlement strategies, which are not correlated, right? When somebody passes away is not dependent on how the economy is doing. So those are attractive alternative investments for clients that want to diversify and don't want to take the market or interest rate risk to that extent. Here's my contact information. The best way is actually through email, but you can give me a call as well and check out more information on our website. The last thing I want to talk about here is how to get the CFP credit. Let me just talk about that briefly. You're gonna read the article here. I'll put a link to it in the description. You're gonna answer 5 questions on the material on Excel spreadsheet. You're gonna just send that back to me. Here's some references. I want to quickly show the spreadsheet. We're gonna send you anything in yellow. We're gonna need you to enter. Again, we need your CFP board ID or the last 4 of your social for reporting. We need your name, your email, phone number. And then you're just going to put an X into the ones you feel are the right answers here for these questions. And once you do that, you're just going to put an X into the to grade. And once you get a 4 out of 5, just save it and you can send it back to me. There's also course feedback if you wouldn't mind filling it out. You know what you thought of it. Also, if you're interested in helping us, in implementing no commission type annuity products into your line, or even commission-based, products. If you're looking at life insurance, how can you best structure life insurance, incorporate that into your practice, how Colville can help you review it. Go ahead and let us know what you think. So you just save that and send it back to us, and we'll submit it to the CFP to get you credit. Anyways, thank you for taking the time to listen. Hopefully you learned a lot. Look forward to hearing from you, you guys who are interested and got value out of this, and how we can kind of better offer these kind of CFP credits in the future. All right, take care and have a great day. Thank you.